Howdy, Team 42. It's your skipper here, Darius to present another episode of Pro to Pro Live. I'm joined by our friend David Levenson. David, man, you have one of the most interesting Twitter accounts and Twitter spaces in the universe. You consistently talk about things that even go over my head in the best way possible. I feel like you've developed a framework throughout your years on Global Wall Street. You were at Bear Stearns. I think you finished up at Goldman and SAC Capital. Everyone knows who these reputable institutions are. And you have a lot of institutional knowledge and institutional insights that help investors, I would say, see through the matrix, if you will, in terms of what's happening from a global capital account perspective and ultimately how it's impacting the economy and asset markets. So without further delay, because I know you got a lot on your brain you want to talk about, just give us a quick background of who you are and what you're trying to accomplish here for investors.
Okay, so as an update, I work as a team, Don Rogerson and myself. He was at Goldman for 22 years, then Deutsche for 6. I started at Bear Stearns in credit forecasting and derivatives.
Yep.
Moved through a bunch of banks. They've changed the names. And then my final was doing macro, micro, and derivative work for a number of hedge funds and portfolio managers.
Nice.
And as the market started getting more interesting following COVID, I spoke to my partner and I said, you're managing your book. You don't have unlimited free time to ignore the world. Why don't we unretire? So we spoke to all of the junior dons, which are the people that trained on his desk. He ran their mortgage volatility gamma book for the last decade of his career, starting in fixed income. And we had met in 1998, 1999. I was down there visiting my sister, who was a superstar at Goldman. Turns out we lived in the same building.
No way.
And we both had a cousin or a brother effect on each other. He looked at the world through the lens of mortgage volatility. And I looked at the world through the lens of credit or equity volatility. That's functionally the same thing. We're both trying to fly a plane, but we don't know who's controlling the other engine. So we decided to merge our model, and it tracks directly with the market. It controls the market. And so ever since then, we've been together, and I tried to get him into SAC in 2002. We had a meeting with Steve. Don will recount that wild meeting someday when he's on the show. Steve was Steve, and he's terrific and brilliant, but he was barking at someone, and Don's very humble, undeservedly so, and it was intimidating. And we try to expand into more fixed income, the basis trade, some hurricane stuff, some just not traditional hedge fund stuff. It's now mainstream, but at the time it was novel. It was so wide open spreads. It was, shooting fish in a barrel. That just was not a great presentation. Didn't work out. Anyway, so fast forward to now, I saw so much on the news with the ARC funds and all the macroscopic talk. So much of it was the Gelman effect. The story of the Gelman effect, it was a physicist who, whenever he read the newspaper and he read an article about physics, he rejected it, said, this is not how physics works. But on every other subject, he said, oh yeah, that makes sense. So I wanted to democratize access to information. I wanted to give the average investor the operating manual for the market. They have all the advantages. They don't affect price with their size. They can get a price signal. So if they understand some of the rudimentary things, and that the acorn, the core, the watch spring, the center of markets is mortgage volatility on one side and equity volatility on the other side, and it's a two-body problem. If you could understand that on some rudimentary level and you're not on leverage, you will beat the market forever. So that's what we try to do. And now I do a nightly spaces. And just a plug for my good friend, anyone who finds this an entertaining interview, your last interviewee, Hugh Henry, he's throwing a summer financial fandango down in St. Bart's. He invited me to go down there. You get an immersive 72 or 96 hours with some of the top talent in finance. Any ideas, any uncertainties, any views you want to tease out, it's a lot more intimate there than just when you're crowding out with 5,000 of my listeners.
Yeah, so I'll see you down there.
Hopefully it'll be great for everyone. that goes down there. Anyway.
Yeah, it's really kind of invite us to that, man. He was a great guy. I learned a lot from him. He spoke very highly of you in our spaces, both on and off camera.
I pay him a lot.
That's good. I'm really glad we're doing this today because, like you said, like you are essentially, like I said earlier, you're helping investors sort of see the matrix in a way that I don't think most investors do. So can before we even start to talk about where you think markets and the economy are headed, can we talk, at extents, about your framework, what you see and how markets work versus what everyone else is seeing, and sort of compare the two?
I appreciate the Columbo opportunity for any of you young folks. Let's find the end at the beginning, okay? The way the markets operate is based on involuntarism, based on failures, based on leverage going bad. When things are normal, you can just ride a channel. There's liquidity. You don't have liquidity gaps showing up everywhere randomly. You don't have policymakers interfering with market flow. The basic function of the system is we have $625 trillion of global assets, and that's producing either yield, income, or theta, if it's in derivatives, and that's just constant, and it's always looking for a home. And if stocks are cheap, they'll buy them, and if bonds are cheap, they'll buy them, because those are the opposite ends of the risk spectrum. The problem is along the way, policymakers interfere with the system. It never lasts, but it's confusing and it creates a decoherence effect. It creates liquidity gaps, but much more important, it creates information gaps. And that's where alpha is located. When there's a liquidity gap, when there's an information gap, and you understand what's causing it, is it toxic or is it just tonic? You know how to make your money. When you're not on massive leverage, you can step in because nobody can sell you out in a derivative. You just have your cash exposure. So we're so excited to be able to share with people this dynamic. So we've talked about the engine, which is the 625 trillion, generating $100 billion a day of yield, income, or theta. It's looking to go somewhere. It goes to the transmission. Now, if the Fed's doing nothing, the market's just going to go. That money is going to go into everything, and you're going to see stocks go up, bonds go up. But when you have all this policy interference and they're changing the gearbox and they're saying, we don't want that money going into bonds. We only want it to go into stocks. We want to get rid of some deflation because of the COVID lockdowns and the massive amount of output gap that was created with nobody's working. So when you have policymakers using that gearbox, they interfere with a simple system. So if you can understand how that gearbox causes money to go one way or the other, or what ratio, you're curing not just the liquidity gap, but the information gap. It's not that complicated because there's too much money, 625 trillion, and there's only 20 trillion on their balance sheets. So they are having to do something we call CPI. It's not the consumer price index. It's called compiled policy interference. And I got to give you this one context. It could really illuminate everything. Alan Greenspan, for all of his flaws, and there were many of them, he started his career 50 days later after his August 11th, 1987 chairmanship. 50 days later, the stock market's down 40%. Crash of 87. He finished his career, the NASDAQ falls 83.5% in 130 weeks. Those aren't good bookends. No. That being said, he understood what policy is used for, rate cuts. They're used to stabilize the economy. They're not used to help a couple of billionaires keep their stock portfolio up. So when we got through the dot-com era on March 24th, 2000, and the NASDAQ, and I'm going to use the QQQ because many people can process that number, it was $120.50. He waited for it to decline by 57% over 9 months before he applied 1 basis point of Visa.
Wow.
And he went from the Mag 7 of his day, which was 30% of GDP, to go to 13% before he deployed 1 piece of tonic, 1 basis point of easing. He allowed a minus 57%, where the NASDAQ accelerated lower than the S&P's decline by 3.3 times, 57 versus only 17.3. That's a massive expansion, a massive divergence, a massive decay of the coefficient of correlation between the NASDAQ and the S&P. Powell, on the other hand, who will go down in my personal view as the worst central banker, far worse than Arthur Burns, he literally saw commodities explode higher. And Jeremy Siegel is pulling out his hair on CNBC. Commodities are in full ascent, and the guy can't find the push button on rate hikes. Think about where we were when Don and I started our decision to democratize information. We don't charge anything other than you have to donate money to your favorite charity, not ours, lend money to your family, donate time to the blind, the elderly. That's all we ask for.
Love that.
But our first tweet, it's on our X account, was January 3rd, 2022. Maximum short, the NASDAQ, crypto, treasuries. Don't go into Staples Healthcare and utilities. Jump over them into Smokestack. Our first hashtag, so buy me. Silver, oil, mining, industrial. The Smokestack, because we were losing QE, we were 1% treasuries. You were going to compress. We never knew Powell was so weak that it would stop accelerating the hikes after 3 meetings. He came into 2022 with a summary of economic projections of 25 to 50. At year-end 22, with 400 PhDs, they were each wrong by 1 basis point. They finished the year at 4.25. These people are very dangerous if you're listening to them and not guys like Dale or us.
I agree.
They're so late, always by design. Their data is like, we have so much money, 325 trillion of fixed income producing 50 to 75 billion dollars a day looking for a home. And they'd say, wait for data to buy rates. Do you know? Well, you know, but every single note, 2s, 3s, 5s, 7s, and 10s are all below the Fed funds rate. You will not hear this on CNBC.
Totally.
They talk about rates going up. What are you talking about? They're melting down because there's too much money coming. So there's a thing called the knob from the 80s, the note over the bond. Because under Powell, under Volcker, who, although not his biggest all-time fan, had some guts, he inverted the curve 481 basis points. People are crying over a minus 100. It was 20 versus 15, 21. What are you crying about? So what's happening is you've got all of this money looking for a home. Powell's saying transitory. And then he super accelerates. He goes 25, 50, 75. Remember, on May 4th, he has a press conference. Says, I'm not doing more than 50. It's too much. What? So he ends up doing the 75, but that was it. And so we have all kinds of dynamics. Citibank melting down on October 12th, 2022. It's 3.25% market cap to debt. You have them recycling on October 24th, 2023, a year, 12 days later. They're down at 3.15% market cap to GDP. We just lost Credit Suisse overnight. Their AT1s, their alternative, their capital vacuum, the COCO bonds, the contingent capital. We know that the Fed says they have 2 mandates. That's not true. They have 1 mandate and 2 daughter mandates, bank stability. And when Jane Fraser or Jamie Dimon, on behalf of Jane Fraser, says, you got to cut or I'm not opening for business next week, they cut.
Oh, yeah.
So we're dealing with a system with so much money looking into so few buckets. It's that Lucille Ball television piece, which I put out all the time. They speed up the conveyor belt. She cannot wrap the chocolates. She's wrapping them and eating some and putting some in her blouse. And there's too much money for things to catch. So we have a chart that they'll put up showing the 1929 super spike in that one, the super spike,
right
that
here.
one, yes.
Yep.
And it shows that you had a 600% rise 3 years after the end, approximately, of World War I, the Roaring 20s. But if you look at this chart, it's one of the massive, consolidation, concentration, overvaluation. Doesn't matter which one you look at. It'll all show you that the AI and the dot-com bubble, railroads and electricity are about as innovative as a robot compared to a computer. But you'll notice there are no plateaus on any of these. They do not stair step. They go all the way back down because, yes, it's a great idea, but there's no profitability because the first mover advantage is the first mover not knowing what they're doing and overspending, no ROI. Now, if you could bring back the Smoot-Hawley and the Fordney-McCumber tariff, I want, yes, this
one here, this one.
No, the one that goes down in 20 to that one, yes, that one, yes. So when people are talking tariffs, we cannot ignore it. The amount of misinformation on this, and I am a centrist Democrat my whole life. We can put up my picture from a year ago with Chuck Schumer, or the one in the same position at the Democratic National Convention when Clinton went over the top. We're both grayer glasses and heavier. I'm a centrist. But stop letting Trump derangement syndrome cost you money.
I
A tariff is a tax. A tariff is a tax. They both start with TA, and they're the same thing. The difference is a tariff is much better for the economy than a tax, because you get to decide what you want to do, and businesses get to decide how they want to deploy capital into a price shift. When the government's spending money, that's how you get Great Depressions, because they're spending money and they're just throwing it away on stuff that's not recursive. It's not going to be repeating. The one-shot deals, we spent $42 billion on what, charging stations or rural internet. None of them work. None of them have anything, because it's the government making winners and losers, and they're losers at picking winners and losers. That's why they're government. Businesses are better.
That's a quote. The losers at picking winners and losers. So tell me about this chart.
So this talks about, we're running the country on tariffs. Yeah, we had taxes around the Civil War. They ended. We started income tax in 2013, very, very mild. But it was mostly tariff based, and we had about we had a like a 40% tariff, and the Democrats take over power, my party, and we said no, tariffs aren't good. So we end up cutting tariffs. Tariffs go down. We get World War I. That's a big inflation impulse. But World War I ends, and just like after the GI Bill in World War II, you've got massive deflation. You've got massive deflation. So they're spending like crazy to try to absorb that output gap. And then the stock market starts to roar in 1921. It goes up for 8 years, 600%. Along the way, Fordney-McCumber in 22, they raised the tariff from 27 to 37, 38.5 on average. That created a disinflation impulse. But the disinflation impulse in a period of accelerating inflation from a stock market bubble neutralized, and it let it keep on going. We didn't short circuit what would have been an overpriced blow off top. We neutralized some of the intensity, made it more durable, and that's how we got 1922 up to September 3rd, 1929. And all you'll hear, you won't hear about Fordney-McCumber, which accelerated and strengthened the innovation period, the Cathie Woods time frame. But then what happens is the stock market peaks September 3rd, 1929. 71 days later, 50 trading days later, it's down 48%. You throw a tariff on them, that's not good. Because you have the deflation from the asset prices, like GFC. Do you remember, probably, on June of 2008, inflation was 5.6 year over year, excuse me. 13 months later, it was minus 2.1. We lost 7.7% of inflation in 13 months. The stock market, asset prices. It took us longer to get the stock market, not 12 weeks like in GFC. It took 130 weeks after Y2K. But we also had a strong Europe. The dollar went up initially for 15 months, after the peak in Y2K. So I don't understand how people think we're going to have a weaker dollar on trend with an asset bubble. So that is bizarre. And then we retested month 22, but then the dollar fell $50, 40%, while China's growing at 11, Europe's growing at 2.5. We've got none of that now. There's no place to put your dollars. These people can't sell our treasuries, like was the rumor recently. They'll push up their currency that already has to go lower to get their goods under the tent of American tariffs. So this chart is showing you mathematically, factually, not Trump derangement syndrome-wise, that tariffs can extend a bull market when you have inflation. Okay. But when you have deflation, it will exacerbate
credit expansion,
it.
you're saying, right?
What?
It's the credit expansion, not the what we normally think of as inflation. It's the credit
inflation
expansion.
Or credit. It's inflation or credit. Okay, same thing. Okay. But what's happening is you throw on a tariff at a time when you already have deflation from a minus 50% stock market in 71 days, not 71 weeks. And then you raise the highest tax rate for an individual to 63% for the investors. That's the Great Depression. That's not now.
Yeah, I think
now, very important in terms of.
Here's that chart.
Okay, that's that one. Now, I don't know if it's on here, but there's something called the output gap. The output gap is the difference. It's kind of like industrial production. They report it and they say, what's the capacity utilization? You could look at it globally. You could look at it locally. Volcker in late 79 had this 400% increase in oil prices, $290.73, $40 in 1980. We in the Northeast, you've got to heat your house with the pipes burst and the house goes bad. So they had to allow inflation until they could contain it. Volcker takes rates up to 20%. He creates two recessions. He takes the output gap from no output gap to a 9% output gap at the election of the midterm of Reagan won. Reagan lost 26 seats, 1 Senate seat, 26 House. Tip O'Neill, he had a 109-seat majority. 2 years later, Reagan won 49 states. He would have won 50 if he didn't shut down, out of courtesy to Walter Mondale from Minnesota, the Minnesota office. Go figure the change in politics, Walter Mondale to Tim Walz. Amazing. The world changes. But what happened was he had 3 years to do it. Nobody pressured him. He was hired by Carter. Milton Friedman under Reagan at the beginning tried to do a hostile takeover of the Fed. Volcker said in the interview with Donald Cohen at the Fed interviews in the late aughts that they tried to do a hostile. He said, no way. He was a diehard Democrat, no matter what he says his electoral politics was. He didn't care about the election. He was going to get rid of inflation. He did too much. He hurt too many people. Your parents went through this. I went through it. It was terrible. But it took 3 years. Trump doesn't have 3 years.
Not at all.
He cannot lose 26 seats in the midterm. That'll give him a third impeachment. What he needs to do is he needs to get the output gap, not in 3 years, but in 3 quarters. So that's why he's acting like a maniac, because Besson told him, Mr. President, I broke the Bank of England with my team. We could certainly break the emerging markets. They're not even England. They're not part of the Anglosphere. They don't get money from the emerging markets as a savings destination. So that's what all the chaos is. But at the same time, go on any TV show, within a minute, you'll hear the word chaos, chaos, chaos. So now it looks like the Trump puts on the 10-year note because they want mortgage rates at 4%. They want egg prices at $3. They want gasoline at $2. And they want the dollar stores to go back to when it was $1. And that's how you win.
Because of this chart here?
And that's this chart you're going to show.
Yeah.
If you look really closely with a magnifying glass and you zoom out, you might see a little black line. That's half of American wealth. Okay?
Just this part. Just this part.
You can't even see it.
I'll zoom in so people can.
That's half of the American population. You think they care about NVIDIA? You think they care about Applesoft or Google's on? No, they care about the gas station and the food store. Take a look at Kroger. Take a look at Walmart, Costco, BJ's, Village, all of the foods. They're at the height. Dollar General, Dollar Tree, coming back from death. These people have an extra buck in their pocket from gasoline. They don't notice this. And no one's opening their 401k. It's a 201k. It'll go to a 101k. They know it will come back, but they've got to pay the mortgage. You got to make the donuts. This is Trump's new base. Trump just announced, I'm going to put a tariff on the on the rich. They're going to pay 39.6. I'm not waiving it. I'm not renewing the tax cut for the rich. I may take it to 40. Maybe it's 2 mil, not 1. I'm going to get my extra tax. That's the party not of the millionaires and the billionaires. Mm-hmm. Then you go to the pink. That's half of America. That's half of America. They don't have anything. Their house is more valuable than their stock portfolio. And let's go into the number of the St. Louis Fed right there. St. Louis Fed says we have 35 trillion of home equity. We only had 8 after GFC. So 8 plus 12 is 20 trillion after GFC. We're 35 plus 13, that's almost 40. We're probably close to 40 right now as rates are coming down. What is different? Things are never different. What has evolved? We didn't have Fannie Freddie. And the banks, as you could have shown or show later, the credit expansion of losses in the savings and loan era, where when the rates went up, nobody suffered. Right there, you just had it with the one just, yeah, that one. This shows when Powell was raising rates, Silicon Valley Bank blew up, unrealized losses on sovereigns, on mortgages. They exploded, but they didn't cause contagion. Why? Because the government is legally allowed to lend you almost infinitely against a sovereign because it's always going to pay no matter how long. Totally. But credit that Dale highlighted, when you slow down and you weaken and then the junk spreads widen, emerging market spreads widen, investment grade widens. Those are loans the government can make. That was TARP after everything blew up. So what happens, unfortunately, is banks, when they were the primary mortgage issuer, and you saw a rise of credit decay, they could not, by regulation, create as many mortgages. We have cured that problem, folks. The market is neuroplastic. It finds a pathway. Mortgage-backed securities are our answer. Not only don't they not make fewer, they charge you less. Mortgage-backed securities will go down in yield, up in price as prevailing interest rates fall in an economic slowdown. And so we will not see a cyclical deceleration in home finance credit origination. So the housing bubble can expand. You can get more entropy in a slowdown. In this slowdown, we could never do in the past. 1992, August 12th, Mexico calls Volcker and says, I'm sorry, I can't pay my bill in 4 days. It was a lost decade in Latin America. July 2nd, 1997, Thailand says, I'm sorry, I ran out of loot. Asian contagion. Yep. Rates go down, but you can't get the mortgage bubble popping. We get the entropy. You know, it's like that soda stream that you push down on the silver bar and it goes from the CO2 canister into the water. Mortgages are getting more bubbly. People want to buy them more. Go look at the last 2 weeks from the Mortgage Bankers Association. On Mortgage News Daily, you can see it, or on CNBC, Diana Olick reports it, or you can subscribe. We were 24% year over year housing purchase activity, which is high torque, hardcore GDP, with all the radiated activity, even though mortgage rates were 52 basis points higher than in September. I'll accept some seasonal differences, September to April, but there's rising entropy in a household. What does that mean? Since COVID, you've had 2 children. Since COVID, 2 of your kids went to college. You have an imbalance. It's not just an asset liability imbalance between the investor in a mortgage and the funder of the mortgage. It's you got to get out of the house, whether you go rent, whether you go at a higher mortgage rate than you otherwise planned and cut everything else out. You got to get out. And then we had news today. We took a 2-year high out in adjustable rate mortgages. That's supply coming out of the long end of the curve. That's a market-based flattener to neutralize Powell's steepening. So when we talked earlier in this interview, Greenspan, for all of his negatives, let the market fall 57% to 13% of his top 7 versus GDP. This guy Powell was cutting and moving markets to new highs. Why would you do that? Save it for the economy.
Yeah.
You could make the argument they want the stock market up at its highs when he leaves, with nothing left in the arsenal. The tank is empty. And then the market could crash into the midterms and cause damage to the other party. We don't know if that's true. It's a speculation. But what we do know is Greenspan kept his 650 basis point arsenal until the market was down 57%. Then they did that conference call on January 3rd, 2001. The NASDAQ goes up 22%, close to new high the next day, 29%. They blew up guys right and left. Now, we happened to catch the same one on April 17th when they did the surprise cut. That we sensed was happening, and we recommended SAC get flat for that. But the key is rates going down has historically decelerated home finance activity because of the regulatory limitations of the primary creator of mortgage credit. That's not the case anymore. We've evolved beyond that. So mortgage is the center of the world.
So I do have a big question before you keep going. It sounds like there have been some sort of either regulatory or market-based solutions to resolving this constraint that we used to have in terms of originating mortgage finance into downturns. What is that solution? Talk to me about that in terms of how this is today.
So again, not recommendation on individual companies,
of course,
but you have independent mortgage brokers. Chris Whalen, who's a great follow on the X.
Great. Yeah.
Okay, he's really the best bank analyst on the street. My favorite bank person is Professor Anada Admati, and everyone should listen to the Odd Lots podcast with her. She's Stanford Business School's. She's just an expert on banks. You know, her famous line is, whenever a bank can raise money, they should.
Oh, yeah.
They're too leveraged. They say, the politicians, if you make me raise more capital, I'll have to charge more, and the consumer loses. Guess what? Fannie Mae happens, okay? So now we've gone to more market solutions. Glass-Steagall. You cannot have someone objective if they're an agent and a principal. So the Rockets, the United Wholesale Mortgage Company, they just do the agents. They get paid on the fee. Now they can do retention. Rocket just trying to buy Coop so they can get servicing fees. They can subsidize and go to what we call the blade versus razor model, where if they're making money on servicing the mortgages and they have all the documents with AI and they send you an email, say, do you want to save $100, $500, press here and we'll redo your mortgage. And then they're making money on the servicing because their cost structure is lower with AI. That's why Rocket is 3 times JP Morgan and United is 4 times JP Morgan, who's the 3rd largest mortgage issuer now. The system found a solution, and you don't have the friction of the cyclical downturn. So if you say rates are going down in the old days, well, it's not going to mean a lot of money going into the bubble, the home equity bubble, the home asset value. Home values exceed the stock market right now. And look at that black line on the bottom. They don't even care about the stuff with the pink.
Yeah.
You can't even see them. They don't care. And the media is trying to get everyone to care about the stock market. No, if you disaggregate, and we're creating something called the polarity tracker. It's no charge for individuals who are not doing leverage. You know, just it'll show you if you measure the NASDAQ market cap divided by the S&P 500's market cap less than NASDAQ's market cap, because the NASDAQ was 29 trillion of the S&P's 52 trillion, so it was 29 to 23. You measure, because you don't want to measure the NASDAQ versus the S&P. So much of the S&P is double counted. You're using up balance sheet. So you want to short, it made money from the peak on July 10th, 2024 to short the NASDAQ 100 and fund that with the S&P 403 because there's 403. And that made money. It's like 12%. If you want to look back at the numbers, go back to November 20th, 2008. That was the low of the NASDAQ 100. And you could see the NASDAQ 100 accelerate, the S&P going up, but that expansion just 5,711 days, 15 months, 15 years, 7 months, and 20 days, where the NASDAQ was accelerating faster away. That is one of your poles in your polarity. Maximum entropy, maximum outperformance, maximum risk on, minimum equity risk premium. What is the other? When treasuries rally faster than mortgages, because mortgage is a short volatility, just like equity is a short volatility. They're both short volatility. So you have tails, you have skew, you have kurtosis, and then you have the next four levers. But what's happening is you had the NASDAQ accelerate for 15 years, 7 months, and 20 days, and it stopped. They were both still going up, S&P and the NASDAQ, but you could measurably see the deceleration. If you exponentiate it, it enhances it. Where are we now? Yesterday at the close, we were 5% less than the NASDAQ versus the April 10th, 2024 peak. After today, it's now 6%. But keep in mind, why did it take 9 months and it took Greenspan 9 months to go minus 57, minus 39.3, excuse me, Greenspan got minus 39.7, where we're minus 6 if you just do the straight division, because Greenspan let it go down. He didn't get the staples, utilities, low vols, the lower rate. So what's happening now? We had Powell cut 100 basis points, Price in another 101/8 basis points. He cut QT by 66 billion, 55 billion, which is 660 billion, which is the equivalent of a 66 basis point cut over 10 years from an interest rate standpoint. So Powell was basically cut 2 7/8. Okay. And that steepens the curve. It weakens the dollar. It preserves some of the tech earnings, which are far more exposed overseas. 51% for FANG versus mid-cap, which is 25. And then staples are only 2. So when the dollar resumes its natural trend of all the money coming here, notwithstanding the media noise and the Germany saying they're going to spend 500 billion euro on bombs to kill babies, that's not happening. Speak to any German who's not in the government. They're never going to spend that much money. So they jumped their rates 65 basis points up to 290. And that compressed the recent 210 basis point premium of the US 10-year to the German 10-year bond. We took that down to like 160. That interest rate differential compression brought the dollar down. That's what caused the dollar to go up so much in 2022 and move the market down, because we were driving rates up faster than them. And we have mortgage extension risk, which is our rates go up, mortgages get longer, people have to put on more liabilities because the asset side of their balance sheet gets bigger. The mortgages swell. They absorb trillions and trillions and trillions of dollars of liabilities.
This is very important.
But when rates come down,
this is what Hugh was alluding to this, and I surmise that you may be even better than Hugh at explaining this. Can we slow down and explain exactly what you meant? This seems like this is the acorn you talked about earlier.
Yeah. Okay. Assume the life cycle. Baby, 7 years. Baby, 7 years. Baby, 7 years. Baby goes to college. That's the average life of a mortgage, about 7.5 years, in a normal, unpolicy interfered with process. When you want to stimulate an economy where all the businesses are dead, you lean on the accelerator, you flatten the curve with QE under Bernanke, and you're getting all that mortgage activity. So even though there were challenges from the issuance because of the banks being weak in 2008, Fannie and Freddie, it still was a way of getting people to use their cash to buy housing. Fast forward to COVID-19, QE down to 1%. It was bananas. I mean, everything was fantastic. Housing, all these mortgages, you can show the histogram that we have for the mortgage distribution. 70% of mortgages are below 4%. You can look at that two ways. One is you can say, we'll never get a refi wave. The other thing you can look at is it's a tail. So we're going to get all the way down there right away without supply coming out because there's so little activity to come out. So what's happening is, as Powell raised rates and he made mortgage rates go up, banks were forced to get more liabilities to pair off the swelling asset side of their balance sheet. You had a mortgage, let's call it 12.5 trillion of mortgage debt. And you have, let's say, an 8-year average life. That's 8 times 12.5, it's 100. We always divide by a 10-year note future so we can commoditize or unitize debt, whether it's treasury debt or mortgages, because they're both sovereign. So that means 100 trillion divided by 10. You have 10 trillion of balance sheet could absorb all of the mortgages when the average life is 8 years. What happens if they keep on raising and mortgages extend out another year? That's another 1.25 trillion of 10-year notes you gotta have on your balance sheet, because you're not getting the cash flow back because nobody's refinancing. So you've got to put more liabilities. You've got to lengthen your average liability. Well, you're selling treasury, excuse me, you're putting on more liabilities, you're funding longer term while the government's got this debt. Then we're getting the downgrade, then the QRA, the quarterly refunding. So all of this extension risk sucked. It was like a giant sponge sucking up all the space on the balance sheet of banks and the system. What had been 7.5 years shrunk to 4.5 during COVID. You only needed 5 trillion of 10-year at the depths of COVID. You ended up needing 10 trillion more, 5 trillion additional 10-year to be able to offset the asset liability match, which is what blew up Silicon Valley Bank. And this thing is now, yeah.
And you're saying they need 10-year equivalents on the liability. Obviously, if they had 10-year bonds, that would be on the asset side of the balance sheet. Are you saying they're raising debt in 10-year equivalent
so
terms?
they have to get more funding because they're not getting the cash flow. So look at Silicon Valley Bank. They blew up because people want to do the redemptions and they didn't have any cash. What happens when you have a 2-year T-bill? The government will fund you all you want. You can borrow against it, pay off. But they had mortgages that got extended. Totally. Well, what if you have a 5-year mortgage, 7-year mortgage average goes out to 10? You're getting no cash flow to fund your operating. You've got to raise more money. You've got to issue more liabilities. Guess what? The government was doing it. And then we were downgraded. Okay. And then, so you're just all this upward pressure. And what's that doing? It's driving down the cost of capital to negative because all the hedge funds were shorting treasuries and waking up every morning with more profit on their balance sheet, saying, let's go buy more FANG with our profits. And how about they're doing it in Japan? The same thing. The yen fell from 2011 when Bitcoin was a teeny little toddler, 60 cents, $60, less than $1 billion. The yen falls for 13 years. Bitcoin goes from $1 to 100K. Now the yen's on its way back up. It's almost a 2-year high. What do you think is going to happen to Bitcoin? It's going to go back in its shell. It stuck its head out like a turtle or a snail. The sponge expanded. Now it's going to go back in. Listen, I am more bullish than almost anyone you could find on Bitcoin. I easily can see $1 to $10 million valuation, but our work says it must go below 10,000 first. It must put its head back in the shell. The system must reset. You must shake all the mistaken excesses. And then eventually, instead of the petrodollar being used to absorb all the inflation that they tried to do in the 70s unsuccessfully, we're getting off petroleum. We're going LNG. How much more solar are we going to get at a 1% funding cost than a Powell 6? So you'll never get petroleum as a rising share of global GDP, especially since emerging markets, when they gain their share and they have a higher utilization, 1 versus 0.5% of GDP for energy, they're going to become more like us. They're going to become more virtual. So petro cannot solve the problem of soaking up the inflation. It will be stable coins. It will be Bitcoin, most likely. And then the Fed loses the power to Treasury. Treasury can say to stablecoin, I think you need another $500 billion a month going into your stablecoin to stabilize it. You soak up the inflation without the Fed.
Totally.
You take money out of the system. You take M2 out of the system. It's a hostile takeover of the Fed. It was Milton Friedman's dream.
Well, it goes the other way too, though. That can go the other way too.
No, exactly.
Yeah,
And that's
yeah,
too much power, you could argue. But
yeah.
it gives the Feds that you don't need that much in stablecoin. Send that money out. I need some juice in front of the election.
Totally.
Biden, they said, spent
100%.
$800 billion in 6 months to help Kamala Harris, while the Europeans held their currency up so that the US currency was weak and the stock market was up, and all that policy interference. That's nickel and dime stuff.
Yeah.
How about when we have a $110 trillion global economy going up to 150, 200 trillion, and you say we need 40 trillion of stablecoin to take 20% of the, and then you say, you know what? We got an election. It's not going to be Clinton leaking from the SPR a couple of barrels to get gasoline down. We all know he did that, right? Biden did the same thing. He stopped SPR in front of the election. No. How about saying, I want you to release, I don't know, $2 trillion of treasuries, drive the price down, put all the P&L on the hedge funds who are short. They'll go long equities. Everyone will be in nirvana.
Yeah.
Too much power.
Too much
that
power.
being said, that's the math.
Yeah.
So you have to do this reset because mortgages are the sponge. They're the clock spring of the system. Powell can make us go in reverse. He can make rates go up. They've been coming down for 45 years or 700, depending how far back you go, since the Magna Carta. When you chop off your head, a king chops off your head, no recourse. Why would you save? Okay, now we're coming down. Rates are going lower. Okay, curve is flattening. Powell's trying to stop it with a diverter, but he can't. There's too much money in there. And now the only way he can slow it is by cutting more than guidance. Greenspan did nothing. This guy's already emptied half his arsenal. If you add back the 90 basis points of QT, because it's not, it was 60, it was 60 billion of UST plus 15 billion of mortgages. That's 75 billion monthly times 12 is 900 billion. That's 90 basis points equivalent. So 5.3875 is 6.275. We were only 22 and a half basis points, and we've deployed all this. The arsenal's empty. It's empty. Our deferred rate, our low rate on the curve is like 3.30, as I said, 3% going out to September of next year. You've already throttled down most, only 20 basis points left of QT. Why are you doing it? And so as we get through this process, you don't go to zero before the Fed is impotent. No, they cut another 100 basis points. No one's going to listen to them, because then what's left? Only another 100. So we'll get the domestic carry trade. You'll get the yen unwinding of their carry trade. Our rates go lower. All global curves flat, notwithstanding the ridiculous thing that they're actually going to spend 500 billion. Nobody serious believes that. And then the other problem is Italian debt is 135.3% of their GDP. Germany is 63%. It doesn't matter about Germany. Italy can't refinance above 4%. Everybody knows the ECB will come in and buy the paper. So now what's happening is everyone's shorting Italian paper and buying the German paper, because they know no one's going to allow Italy with that kind of debt. It's a big country. It's not Greece. They're not going to let those rates go up. And because they're not, it's driving down the German rates. The interest rate differential that weakened the dollar is about to end.
Well, this is what happened with the exchange rate stabilization back in the 90s, right? Everything converged.
That's exactly. But we have so much more liquidity in the system right now. The Anglosphere, the West, gets 70% of all the savings from the world. The US, UK, Canada, Australia, New Zealand. So right now, some people are going a little on strike. They're sending a little more to the UK. They had 2.6% inflation, a little lower than target. Their short end is falling. But I'd like to address briefly some of the way we work, because a lot of people do technical analysis. They do charts. That's called gamma or cash. That's the price. Yeah. We do intermarket work between different products. It's all in one large field. Emerging markets was the first to start to fail, and that pulled down NASDAQ. Why? Because they're their final marginal consumer. And as emerging markets started to fail, it's a measurement of deterioration of global monetary liquidity, inadequate dollar supply, inadequate yen supply. And so they start to widen. The next thing you know, they're in the same space as non-rated high yield. And so they started to widen. And then investment grade started to widen. Now, Powell can cut, steepen the curve, which is a tachyon. It makes time go backwards. It tightens, but it's only a temporary tonic. It eventually will widen because there's not enough money to keep these things tight. And then weaker energy, that starts entering the unrated space from all the debt on oil companies that are investment grade from the war pricing. Now we got down to 54 in deferred contracts. So we're seeing deterioration of global monetary aggregates in a 6-month forward. So you're not seeing it, it's not being reported. But if you understand mortgages, it's inevitable that we will see massive annihilation of M2.
So
back in the 80s,
that's a big statement. If you understand mortgages,
if you understand mortgage
we'll
dynamics,
global annihilation of M2. Can you walk us from that statement back to what you said earlier about mortgages,
and you understand the sponge or the Acon or the clock spring?
I'm asking you to help us understand it.
Okay. So what happens when mortgage rates go down? What is the behavior of people? Two things happen. One is more purchase or refinancing in the 30, or some will actually go to the shorter end. But it annihilates a 2,500-day piece of paper and turns it into a money market. You're just evaporating all that duration and shrinking the need for the asset side of the balance sheet to accommodate the asset.
Or the liability.
And so the asset viscosity, the ability for the asset to get longer with higher rates or shorter with shorter rates, that viscosity is lighter than the viscosity of your liabilities. You're needing to fund. You're needing to move your liabilities around. Powell has been using pump jacks, and Biden used pump jacks from a broken down service station where they just, if you're in New York and you get a flat tire, you go to fix a flat, on the side of the road, they put one of these pumps, they push down a long pole, and it just causes your car to go up. They'll either plug the tire right then or they'll take it off. Okay. But the seals on those pump jacks are leaking oil, and they keep on putting new ones. Those are called rate cuts to make sure the far end of the curve doesn't rally. The 625 trillion of assets or 325 of fixed income doesn't push up those treasury prices, push down those yields. They're holding those yields up for dear life. They're running out of pump jacks. The old ones are completely useless. There's no more pressure. That's called CPI, compiled policy interference. But it's net because the first rate cuts are already gone. They're not influencing. Where are we? All rates are below the Fed funds rate. Not the Fed funds of 5 3/8, the Fed funds of 4 3/8. Nobody's talking about it. They're all focused on the internet stock known as 2s, 10s, 30s, or 2s, 10s. If you play the game of Twister and you look around the corner, you might be able to see something. But if a rate is below the Fed's funds rate, then someone is paying money for the right to buy a treasury. They're having a funding cost just because they know what's going to happen. So these pump jacks, they're running out of them. Powell used them. Greenspan didn't. And that gravity, that 325 trillion pushing down on rates, is requiring more and more policy interference, which is running out. So as rates come down, look at the mortgage bankers. Yes, last week it was 24% year over year, the most in over a year, even though rates are 52 basis points higher than they were in September. Today they were 15, even though rates were 70 basis points more than September. It's because the entropy in the household is saying, get me out of this place. Get me a rental. We're going to get divorced. Get me out. And that means they're annihilating 2,500 days of the option. The banks are short the option. The homeowner's long the option. Rarely would you ever exercise an option early because you're making money being shorted.
Totally.
But if you're long it, okay, and you got to get out of the house, I don't care. I got to get out. So that's why JP Morgan on September 12th, 2024, called out the day after Loretta Mester, the former Cleveland Fed pres, she was on CNBC saying 25 sequentially, we're good. He said, no. Not Jamie, one of his spokesmen. We're having net interest margin issues. That's not enough. So we went out and we were talking about it on our spaces in advance. 25 won't be enough. If they don't, there's a non-zero chance they have to go mid-meeting. They cannot let these mortgage rates keep on going down, because from this chart, it shows there are no mortgage supply. You can slice through that like a hot knife through butter. There's no supply until you get down to 4%. It's all the Fed with their interference trying to steepen the curve, weaken the dollar, pump up the stock market, that's stopping the money from going here. But if you look at what the NASDAQ has done and you do a vector calculus, a policy differential equation, a policy partial differential equation, you strip out what would happen if Powell did nothing. If Powell didn't cut, the dollar would be higher, the curve would be flatter, spreads would be wider, the credit default swap guys would be going to town a long time ago. And the stock market would be way lower, and Trump would have many more seats in the House. Okay, do that exercise. We're already back below there.
Yeah.
The policy has bled off. We don't have an infinite supply. Greenspan held 650. These guys don't. So the key is mortgages can absorb, but they can discharge. And when they're discharging that duration, they're driving down rates. And now we have the added factor of higher entropy, of too many kids, too many empty bedrooms. Then you have lower friction from the independent mortgage brokers. Then you have lower friction from non-regulatory limited capital inflows into mortgage activity. So if you're a mortgage expert, you're probably not getting this. You probably don't have this in your models. We've surveyed so many of them, they just don't have this in their models. This is the information gap. This is where you are seeing why are rates going down and the data isn't. Because there's $325 trillion. Try to imagine building the JP Morgan building on 47th Street with pump jacks instead of girders going into concrete. How long before that would tip over? Right?
Yeah,
That's what's going on. The pump jacks are failing. The money's coming out, and we're going to go from maximum NASDAQ versus S&P after 5,711 days. We have to go the other way because we went so high. We went to 29 levels of overvaluation. This is not corrective. This is the reset. And on the other side of the reset, we're not going to have the Fed raise rates to 5 3/8. Oh, no, no, no. Citibank will be shrunk as a share of American credit formation because private credit will step in and be able to issue credit instead of 16 trillion to 1.6. It could be 10 trillion to 18 trillion. The Fed won't stop at 5 3/8. The Fed will stop at 10 the next time.
Ooh.
Okay.
I think I agree with that, but maybe
after we go to zero, and you don't have to worry about the insolvency of Citigroup, which is smaller than Charles Schwab by market cap. How crazy is that? With 2.46 trillion of assets. So after we go through the reset and the volatility implosion, and the green shoots start coming out, and they start raising rates, everybody and their mother is not going to borrow on margin. No, 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 no. They're not going to want to. They're going to short the 2-year. And they'll get paid for shorting the 2-year and have no liability cost. And then the 2-year will go up in yield enough, they'll drag the 5-year yield up. People will be shorting the 5 years. So all this credit formation of everyone shorting everything, the 493 mortgages and treasuries to buy FANG, until FANG got exhausted by lack of monetary aggregates to push it up. And now we're going the other way. When we revert, they're not going to stop at 5 3/8 because you won't have Citi as your governor controlling how much you can raise, because it's the mortgage extension risk that was going to blow up Citibank. They were losing all their cash flow from the extension of the mortgages. They wouldn't pay their bills. They have to fund more. And then when you go too low, 3%, 295, 270, where are the credit default swap guys going to say, no soup for you, no cash for you? So that's the end of the. So we have a massive deleveraging event. It's controlled by the greatest density in the system, which is mortgage volatility. And then when that goes to its incompressibility level, we call it global agglomerated vague incompressibility, agave index. But when you can't get mortgage volatility any lower and you get negative convexity in mortgages where treasuries move up, it will shred the whole system. It'll blow apart emerging markets. It'll blow apart junk spreads. It'll blow apart investment grade. And all the credit default swap will rain stock and supply and press everything down until they smother volatility to nothing. And then we start the cycle again, because it's a leveraging on, then it's a deleveraging, then de-risking, and then a debasing. It's a very simple cycle. It's just people get habituated to the fact that they last so long on the way up.
Totally. And so why, in your opinion, in our estimation, or based on your analysis, why has the cycle rode over? Like, why is the Fed frantically using its pump jack? Like, what is the underlying fundamental issue that's causing all this?
It's only a speculation because they're not telling us. There's no economic basis for it. I mean, Greenspan literally waited for the economy to deteriorate to use his basis points to stabilize the economy. This guy Powell only seems to care about NVIDIA and FANG.
Yeah.
And if you have the July 10th, 2024 peak, NASDAQ with respect to the S&P, and the only thing that got it through the high, and Microsoft never went through the high again, was the rate cuts. And then we go back below. Again, policy partial differential equation. Strip out Powell like he never. Where would we be without the rate cuts, the curve steepening? Where would we be without the weaker dollar? We'd be where the dollar was going straight up after Y2K for 15 months, destroying global dollar liquidity. We have the yen down. It bottomed after 13 years, July 5th close, July 11th intraday. We're at a 22-month high. We spoke about how January 13th, 2025, as we approached it, yields peaked because the curve flattened from 10s to 30s, showing in the three sections of the yield curve, from the funds to the twos to the tens. Funds to twos are swaps, T-bills, floaters. Twos to tens is mortgage dynamics, some swaps. And then you have and adjustable rates. And then you have the 10s to 30s, which is really the market. So if you're driving up 10-year rates, but the bond isn't following you, that's because there's not really anything more than repositioning. And when the bond flattened versus the 10-year, below the last time the curve was inverted on November 25th, 2024, that to us said, that's it. You don't have net selling pressure if you quantize all of the dollars exposed to the treasuries by year. 10 trillion of T-bills, you only have 300 billion of bonds. It's 30 to 1. How do you equate those two? One's an internet stock, the other one's a money market fund. So that's how you got the peak on January 13th in the 10-year. 6 days later, Bitcoin peaked. And 21 trading days later, February 19th, the NASDAQ and the S&P peaked because it exhausted all of the policy interference. So Powell had to cut again, synthetically, by lowering QT. 20 billion, that's 20 more basis points to try to disinvert the curve more, to weaken the dollar while you've got the German story going on. But none of those will last. They're all policy interference. They're all temporary, transitory, ephemeral. They evaporate. It's ether. We're going to flatten, and you're going to cause those mortgages to tighten, and you're going to squeeze out all that liability that was absorbed by mortgages, and it's going to go all in by the long end of the curve, and it's going to be recursive. It's going to be recycling, flywheelish. It's going to make us go all the way to 4, but then we're going to go below the 4s. And who's going to get voted in? The guy who gives you the 4% mortgage rate, $3 eggs, $2 gas, and dollar stores, or the guy who promised, this guy doesn't know what he's doing. You should just given me more time and I would have gotten it done.
Yeah. So quick question. I understand all that. What I don't understand relative to what we were previously talking about is, you said once the mortgage is compressed, they're going to have to go out and recursively buy 10-year. I thought earlier you had said they were recursively buying 10-year because it had expanded. You're saying they were shorting 10-year back then.
Yes, so they were funding, they were putting out more CDs or more debt because they needed to raise capital because the asset side of the balance sheet expanded.
Gotcha.
So they needed to have an asset side and a liability in pair.
Yes.
But when you're peeling a banana, you're peeling one side, you peel the other. You don't peel all one side and have all yellow and then try to, corn on the cob the thing, right? You're peeling both. You get a refi, which annihilates volatility, annihilates duration. At the same time,
very bullish. I don't understand why that's bearish.
For what? For bonds.
No, it sounds very bullish for asset markets, right? The
No,
mortgage
the opposite.
duration.
The opposite.
I
Okay.
want let me say the whole thing so I can have
Sure.
you
Yeah.
surgically correct me.
Okay.
In 2022, mortgage interest rates shot up, so the mortgage duration shot up. Therefore, you had to, sort of match the liability, match the asset, the increase in duration on the asset side of the balance sheet with an increase in duration on the liability side of the balance sheet. Now we have rates going down, so the duration of the mortgage assets on the balance sheet is declining. Therefore, the duration
Rates
of the
will come down.
liabilities are going to decline. It
Yeah.
strikes me that the decline in duration of liabilities should free up capital to do more capital markets activity. Why is that not bullish for
So
broad
there are
assets?
two elements to what you say that will clarify. Were
Thank you.
rates at market rates in 2022, or are they QE? They were at 1%. So the discount rate was wrong.
Yeah.
So as rates went from 1 to 4 or 5, the earnings got their normalization. That's why we jumped right from crypto tech and that, once they announced, right over to the smokestack, the 5Ps, the 6Ps, because they can handle it, right? They can handle higher rates. They don't care. They love inflation. They love nominal GDP of 13.8. They're living life large. Now it's different. It's not policy normalization. Now it's deflation realization. Rates are going down because there's nothing below our yield curve. That's all deflation. There's nothing under there. There's nothing there. As our rates go down, it's the absence of demand. Powell put a tourniquet on us. When we're at 5 3/8 and there's no blood pressure, he put a tourniquet on so we don't bleed out. So he moved the entire length of the curve into a cloud that only had an upper bound of 4 3/8. So we squeezed like the children's balloons at a clown show, at a birthday party. He squeezed the balloon so there was less space that the monetary had to fill, so it looks like there's monetary pressure. He just amputated a lot of the area, right? 5 3/8 out of 4 3/8. But we're not at 4 3/8. We're actually at 3.
No, but can I slow you down?
Yeah.
Can you explain this to me without specific examples? Why is the shrinking of duration on the liability side of bank balance sheets
What's causing it?
for broader asset markets? That seems like it would be bullish because you're freeing up capital.
No. So right now the real rate of money is going up. As treasuries decline in yield, as they rise in price, deflation is rising faster than yields are falling because of the optimism.
The price
So
of
real
the
rates are
treasury
rising.
is causing the price of money to go up. Gotcha.
Yeah. So as yields are rising, as people are buying treasuries, notwithstanding all the policy games, deflation is right in front of us. I mean, it's asset deflation. It's only being held back. We had massive deflation, minus 7.7% in 13 months in 2008, starting in June. It was faster than in Y2K, but in 1929, 71 days, minus 48%. That was the deflation. Then they throw on, a tariff and more deflation. So we have deflation right now. They're trying to make it look like we don't by putting the tourniquet on and making it look like there's monetary pressure, which is causing gold to go up. Gold will eventually have a very hard time. Not yet, but real rates are rising, and they're masking the rise of real rates by steepening the curve and weakening the dollar by these preemptive rate cuts that Greenspan wouldn't do and they didn't do in 1929. This is novel what he's doing.
I still don't get it. So let's take a step back. For 40 years, interest rates basically went down for the log trend downward.
Disinflation.
Yes, that was incredibly stimulative to asset markets. And the reason I would have surmised, based on your acorn theory, is because we were reducing the duration of the liability side of the balance sheet.
Absolutely. Absolutely.
That's what I'm asking. So why is this not incredibly?
This is all policy interference. This is all policy interference. Yeah. Real rates are rising. The measurement of real rates rising is NASDAQ compressing into the S&P. That is a perfect measurement. When you see a March 24th, 2000, March 24th, 2000, just do any chart. XLP, XLU, XLV, SPY, triple Q. You will see 9,000 basis points of acceleration of the staples versus the NASDAQ 100 over 9 months. That's a lot of alpha. Yeah. They're just delaying the start of that process. They're not letting long rates go down because they're flooding the system with all this money. When you have a $10 trillion T-bill and you cut rates by 100 basis points, you're adding 100 billion of duration to the system by the rate cut. And they're cutting rates too fast, but they're running out. It doesn't mean they're ending deflation. It means they're slowing the acceleration of deflation. But as we get lower rates and flatter curve and higher mortgage entropy, the super acceleration of the annihilation of liability need, which is going to mean everyone's going to have to buy in the long end of the curve. But what does that mean? Everyone that's short a treasury to buy emerging market, bankruptcy. Everybody that's short junk, short a treasury to buy junk, high yield, bankruptcy. We went up to 2000 and they're funding junk at 275 with a treasury. These people are insane. Investment grade. So the credits will all blow out when higher for longer becomes known as hysterical Fed lies. Okay. There's no way that they're ever going to, there's no way that's going to be maintained because
this is a real masterclass, man. I unfortunately do have to hop for another meeting, okay. But can we do this again and maybe bring Don along next time?
When you can schedule it in advance, Don would love to show it. And if you have me and Don talking about mortgages, that becomes dangerous.
A little bit more time.
That's too much information. That's too much information. But we want to share it with people because if you can understand it, it's not as complicated as I'm making it. That's one of my shortcomings, conveyance. But when you understand it, everything makes sense, everything works, and you make all the money.
Well, I was going to say, I'm about as close to understanding it as I've been. I think you and I have been interacting for about 3 or 4 months now. I would say when I first started interacting with you, I probably retained about 30% of the information. I think I'm up to about 65, 70 now. So hopefully next time we talk, we'll be up at 100. But this is incredibly valuable stuff, folks. I mean, if you don't understand the simple system that you devise in terms of matching the duration of balance sheet and how that goes up and down and how that can create money tightness or money looseness.
Changes.
Yeah, exactly.
The speed of the changes is changing also. Totally. That's acceleration and acceleration of acceleration. And it's in nobody's models. We know that 100%. With certainty.
No, you're right. I certainly don't.
That's the information gap.
Totally. This is
the pump jack is not a girder. The pump jack is not a girder. And people don't understand that. They're all going to fail everything, everywhere, all at once. It's been a delight to be on with you. It's been fantastic to be able to share things with people. As people want to learn more, they could just hashtag.
Yeah, what can we send people to come on you?
The hashtag, the mechanics of markets. We do a nearly nightly spaces, about 30 or 40 hours a week. We're trying to get the markets operating manual into your mind because all information, and we know Darius loves quantum physics. We know it. Anyone who knows him knows that.
One of my favorite
The black hole conserves all information. Mortgage volatility and equity volatility conserves all information. And if you know what causes the compression and what activates the unleashing of that volatility, that's where the alpha is. It's 100%. Much easier than I'm saying. It just requires more time to unlearn all the noise you're hearing. You will not hear that all rates, all notes are below the Fed funds, except on Darius's show. You'll hear rates are flying, except they're not. How do you make money when you're hearing something that's not true?
Yeah. Well, we'll definitely do this again, David. I'm really grateful. Appreciate you. Appreciate your mission. Your mission is very much aligned with ours, and I love the fact that people come into your community and consume your information. They have to donate. They have to take care of their community. They have to take care of their family. That's something I have a really soft spot in my heart for. Someone who grew up very privileged or very challenged. I want to make sure that we're giving back, and I appreciate you for doing that, brother. So thank you.
My pleasure. It was great being with you.
David. Cheers, man. We'll catch you out. Catch you next time.